All right, so we are live here. So let's go through the names. So first we got Garrett LaBarre, easy one. We got that from Calvert Home Mortgage. Then we got Jesse Bobrowski. That just sounds like that's such a bro name.
It rolled off your tongue.
It's a bro name, man. It's like some guy that I went to the gym. Oh, you don't know Jesse Bobrowski? I'm like, he's the guy doing curls in the corner for sure. And then Lorenzo Podda. And so Jesse and Garrett, you guys are in from Alberta?
Calgary,
specifically Calgary. You guys live in Calgary as well?
You bet.
Yeah. So like what's going on with the Oilers? Is there any rooting for the Oilers right now? Because they're like the Alberta team left in the playoffs, or no?
You caught us in a tough position here because one of us is and one of us isn't.
Oh, really? So there's just hatred for the Oilers? Like, so one has pure hatred for the Oilers?
I am never cheering for the Oilers.
Okay, but hold on. You were born in Alberta, right?
Calgary, born and raised.
Born and raised in Calgary. So that's the difference.
Yes.
Where were you born?
Thunder Bay, Ontario.
So he's got no loyalty. He's used to cheering for other teams. Were you a Leafs fan before, or are you?
No, I was all my friends in Thunder Bay are Leafs fans. I grew up, I loved the Oilers because it was during Messier Gretzky.
Oh yeah, you're a bandwagon jumper. When you're kids, I was too. I was a 49ers fan for the NFL, so I was a bandwagon jumper there. Yeah.
So the loyalty is not as deep as Garrett.
Yeah, see, that's why. And see, as Leafs fans, we're used to having to cheer for someone else in the playoffs, and usually we go to another Canadian team, unless it's the Habs. We don't cheer for the Habs.
See?
And then, but I can easily be swayed to cheer for the Oilers once the Leafs are kicked out in the next game, right? So
his son just got an Oilers jersey too, so now he's got that bias with his son.
Oh wow!
I love the Oilers, so it goes deeper and deeper.
Yeah, this seems like this can create a problem long term for you guys.
Yeah. No, we're all good.
Cool. Okay, so you guys work at Calvert Home Mortgage. For anyone that's not listening, that hasn't listened to Lorenzo before, you've been on the podcast before with PM Select, so on different mortgage angle. I don't know. So take us through this. Just give us Calvert Home Mortgage. You guys give everyone, just so they have an understanding of where we're coming from. What do you guys kind of do? What's the focus really? Other than mortgages, we can figure that much out.
Yeah, it is. So our focus is very narrow as a mortgage lender. So we focus on lending on short-term residential. So borrowers who have a short-term residential need, we want to be there. And short-term to us, 1 day, 1 year, as long as there's a plan and a realistic plan to exit our loan, we want to support that borrower. With that model, 70% of our business today is lending to real estate investors who are either buy, renovate, and sell, flippers, or real estate investors buy, renovate, rent, and then go get bank finance, build out their rental portfolio that way. So that makes up the bulk of our business today.
So they come to you guys because you guys are more like why do I need to know about Calvert Home Mortgage? Because I can just go to the bank and try to do the same type of thing.
Banks aren't typically wanting to do that short-term lending though. Typically, Lorenzo would know better, but for the most part, banks want that long-term stuff. So if our clients are turning things around, if they're turning things around in 6 months, that's not the business the banks want. So we'll take on the clients from the purchase, and then they renovate the property and either sell it or refinance, and that's when they head to the banks when they want to keep it long term.
Got it. And that's where they'll get lower rates. They'll pay higher rates with you guys, obviously, because of the premium that the product that you're offering.
Yep.
So is the lending open then for you guys? Like, is there no penalty to break? Because I guess it's expected to be short term,
exactly.
Right?
Yeah, it's 6. We write everything 6 months fully open, interest only payments. So if they borrow for a day, they only pay interest for a day. If they need to renew past the 6 months, as long as the loan's performing, we renew it at no cost. But to follow up with Garrett, a couple other reasons why they'll borrow from us outside of the short-term nature. A lot of our borrowers are finding houses that haven't been touched in 30, 40, 50 years. Maybe they've had a hoarder in it, tons of deferred maintenance. So even if they are bank eligible, the bank looks at this appraisal and says, wow, this thing does not meet our standards. No, we won't lend to them. Or another option that we have is we allow the borrower to get in with a very low capital entry. So as long as the project's profitable, borrowers are borrowing from us with as little as $20,000 down. So you could buy a $800,000 house, put $100,000 into it. Let's say it sells for 1.1. You're going to make net of everything $100,000. We'll support that with only $20,000 down.
Yeah, but what else do I need? Because if I have 20 grand and nothing else to my name, you guys aren't going to like that.
You're right. So what else they need is they need to cover that down payment. So the 20 grand, they can put more down, which lowers the interest rate, but they need that down payment. They need the reno costs and they need the carrying costs.
So you look for that as cash in the bank?
No, not necessarily. Like, yes, we like to see some cash in the bank, but they can use JV. They can use credit lines. They can do cash from family, all these different things. We just want to see that they have the capital to be successful in these projects.
And so basically it's as long as you can fund the project, sustain it, and then be able to have an exit, that makes all the numbers work. Calvert's comfortable.
Yeah, exactly. Yeah.
Hold on. Let me dive into this a little bit. So the rate, just so everyone's talking, the rate's high, and which it should be for this type of lending, right? Because the rates, I know it's going to vary depending on some things, but roughly give everyone an idea of where's the rate at for this type of thing.
Yeah, so rates range anywhere from 9.99 to 17.99.
Okay. But
you have to consider that these loans are typically only lasting 6 months. So you can't really, that's an annualized rate.
Yeah, no, it's a cost of doing business. Yeah, exactly. 100%. Yeah, I got it. So I have 50, call it 50 grand. So I got 50 grand. I want to buy a place for, I don't know, what's a 6, 7, call it, I don't know, 700. Well, how do we make the math easy? 700 grand. Okay, so I got 50 grand, 700 grand. I want to do some rentals to this place. I got to put a second suite in. Let's call it 100 grand because it's just for round numbers, right? Okay. So you're telling me with only 50 grand, there's an option. I have good credit, but I have good credit. I have a job, whatever, just like, average, like decent income job, nothing crazy, high, low, whatever. So there's a chance that I can get financing with limited down payment, and just my 50 grand can get me into this property. And then if I have Lorenzo's going to partner up, because Lorenzo money bags over here. Lorenzo's got deep pockets, so he's like, yeah, don't worry, I'm going to give Nick another whatever. Like, what is Lorenzo like? I guess what I'm saying is I only have 50 grand. What else do I have to show to get this mortgage? And I know there's variables and stuff like that. Like, I get it, but just give me an idea. Like, do I have to say, well, Lorenzo's my partner, he's got some money, so here, just look at his bank account and stuff like that?
Yeah, he could be your JV partner. So sending us a JV agreement stating, hey, this guy, I'm partnering with him. He's giving me this much capital. These are the terms. And
is he going on the loan?
He doesn't have to. No.
And then you guys are doing this because the underwriting, you must be coming from a place where you just feel the value's there. Yeah,
so I'm one of 3 senior underwriters at the office, and our main 2 criterias are: do they have the money to be successful in this? And 2, are they going to be profitable with this project? So those are 2 main things. The profitability, we don't want to lend on a flip that we don't think is going to be profitable. We want everything to work, and then when it is profitable, which we hope it would be, sometimes there's scenarios where things go wrong, markets change and stuff like that. But for the most part, if it's profitable, they'll come back to us, right? They keep coming back. But if they're not, then there's less likelihood that they're going to do more projects. So we want to make sure each project is profitable. And by doing that too, we ensure that, hey, if something did go wrong, we can probably sell this to another real estate investor.
Yeah, so it's self-serving. And I don't mean that in a bad way, but it's self-serving. If they set them up for success, then they circle back and it's repeat clients, right?
Yeah, we absolutely want to set them up for success. And the big piece of that is buying right. Like they're all of our clients are making money by buying right. They're not making money because they're doing the renos at $5,000 better than the next guy. They're making it because they're picking the right property, executing on their plan, whether it be to sell or refinance, and making money. So Garrett mentioned, we're in the business of risk. The way we manage it is we've lent on literally thousands of these, $1 billion+ dollars. We have a ton of data of what works and what doesn't, and we arm our underwriters with that, and they're able to make decisions for the success of the client.
Does that, Lorenzo, that's the same, like, I'm looking at the property and the chances of success of it, I guess I'm just pausing because the renovation angle, like, banks would look at the traditional financing, looks at like the rent amounts and make sure that it's going to be successful as a rental. Yep. Because they, if you're buying something for $1 million and you can rent it out for $1,000 a month, they're gonna be like, that doesn't work. Yep. But from the construction loans and stuff from the banks, I guess, are they underwriting it the same way by the way they evaluate the property?
Yeah, so construction loan with the bank's a lot different, to be honest with you. They don't really love to lend on banks don't love to lend on like single family projects, which is kind of cool what Calvert does, because that's something that's kind of a very unique space right now. So it's very cool in that sense, because the banks don't love construction loans on just one house. A lot of times we have to go find private financing and things like that for that kind of idea. And then also a lot of banks, especially in the position that we've done a lot of deals with Calvert as well, is it's homes that maybe aren't up to shape, or there's a house structure but it's gutted on the inside, or there was a hoarder, or it's someone that potentially doesn't really qualify but wants to get into the flipping business, where this is a very easy avenue for them. So that's the best way kind of for Calvert to be used as well. And then from the bank's perspective is they don't really love joining someone's project, especially on the residential mortgage side. That's supposed to be a low risk kind of appetite for them. So if you're saying, hey, I'm going to come and you're going to tell them up front, I'm gutting this house to the studs, it's not something they love to lend on anyway. So being able to go back to them with the finished product is actually a lot nicer for the bank most of the time.
So then you guys feel like you guys basically that's the gap that you guys are filling.
Yeah, and I was going to say, like, Lorenzo hit it on the head with the hoarder house. Like that type of stuff. Jesse mentioned it too. But like when the banks see an appraisal that states the property's in fair condition, they're not considering that stuff. So we can do that. And then the other thing is we offer this great customer service where we can fund.
Even if you say so yourself.
Well, we can fund it. We can fund a deal within 48 hours of getting all the documents.
Yeah, so
there's that speed that the banks don't have either.
And you can do that because your funds you're not creating funds out of thin air like the banks when they create a new mortgage. You guys are raising capital and then lending out that capital that you've raised from other places, I guess.
Yeah, we operate a pool of capital, and that pool of capital is made up of really two sources. We use bank money, so we have a bank line of credit, couple $100 million, and they charge us prime plus 0.5. So we use in our, I call it a capital stack. We have bank money, and then we have shareholders. So we have high net worth individuals, family offices, and fund managers who work with us, provide us capital. Every year, we lend out that money. We earn interest. We earn fees. Goes into the fund. We are a mortgage investment corporation, so by definition, we are not able to carry forward earnings. So we have to net out our earnings to our shareholders every year, and we provide them that return. So our goal is just to kick ass for our borrowers, manage risk, and provide a decent risk-adjusted return for our shareholders. And historically, we've for 41 years, we've been doing a pretty good job at that.
Has it been that long you guys been around?
Yeah.
We're focusing on this particular niche specifically, or not so much?
This niche has really supported our growth. So we've seen really tremendous growth the last 6 years. But even 30 years ago, our founder, Everett, he was working with some CFL players who in the off season would flip houses. He was a mortgage broker, and he found that nobody, as we've discussed now, through traditional means would support them. So him and a business partner decided let's support them through the fund. So that's kind of how it came to be, and we've always had a really good lens on supporting real estate investors. So the way that we look at it today is if you go down a street, 1% to 2% of the houses are not marketable. Like they're run down. The general market does not want to live in them. Canada right now is undersupplied as it relates to housing. So these people are picking up these properties, renovating them, making them marketable. In a lot of instances, increasing the density, like up-down duplex. Mm-hmm. So that's what we're supporting right now in the market, and we see a long runway for this.
That was going to be one of my questions, which is, what are you seeing I guess maybe as a percentage basis, how many people are flipping the property and making it nice and reselling it versus trying to put in additional units?
And keep it after that, yeah.
So how many are burring versus flipping?
Yeah. Sure, yeah.
Yeah, it's pretty close to 50-50.
Really?
I'd say more flipping. And I think when the market changed it was
a year ago,
January to April, you got to change your strategy. And that's when a mortgage broker comes into play, and it's important for them to work with someone who can say, hey, yeah, this could work as a BRRRR if we flip it over to the banks, or maybe you need to sell this because you can't hold on to this.
Got it.
It's not profitable.
Did you see less people refinancing things as well at that time?
A lot of less refis too, just and sometimes doesn't make as much sense anymore, right? There's still cases where it does. A lot of real estate investors still need access to capital to be able to go buy property. So that a lot of stuff makes sense there. Sometimes debt consolidation, but the average refinance of just, hey, I need to lower my mortgage rate, that's obviously gone completely away. And obviously the need for, hey, I might not be buying a house right away. I might be waiting 6, 7, 8 months to kind of buy the house. The refi sometimes now all of a sudden gets delayed as well. So it's been definitely lower activity, but I guess I kind of had a question too in terms of the appraisal process for you, because I know it's obviously a lot different than a lot of lenders. So if you have someone say, hey, I'm going to keep this house, but I want to put very minimal down payment, that $25,000, $30,000 down, even if they want to put a little bit extra, how do you guys run that appraisal process for people?
Yeah, good question.
Yeah, because I know it's a little bit different.
I was going to get into that too, because Nick was asking about how we operate that fast.
Yeah.
And that's a big part of it, is we do our own internal values on these properties. So we have 4 appraisers on staff who are able to do appraisals via desktop. Mm-hmm. And we also, now I actually just hung my license with Rockstar to be a realtor.
Yeah,
so
we're international, sorry, not international, national brokerage.
Right,
you know?
right.
International. Yeah.
So we can get the data online and do these values within 24 hours from Calgary.
Yeah.
So that's kind of how we do it and speed things up. And then the clients don't have to pay for that third party appraisal either.
So if someone was to come and say, hey, I'm looking to put the $20,000 down, but my exit strategy is refinance. So is there times when you're like, hey, well, we can't make it work with the $20,000 down because your elevated value after is probably not going to get you a refinance?
Yeah, sometimes for sure. That's why on each one of these deals, we need a detailed reno budget. It needs to be as detailed as possible, because think about an appraiser. Like we call them internal evaluators because they're not acting as appraisers. But think about them from a desktop standpoint and not being able to see a property as what it would look like when it's renovated, right? Like it's tough to do unless you have all the data and information to be able to do that. So we get that detailed renovation budget and all the, like, are they knocking down walls? Are they putting in a new bathroom? All this stuff. And then we do that value. And if that value is coming in a little lower than what our clients are thinking, sometimes we say, hey, like, let's put a little more down. We can make this profitable and lower your interest rate by you putting more money down.
Yep.
Yeah.
If I get a mortgage, so actually, Lorenzo, let me ask you first. So I get a mortgage on a property. I'm going to do one of these things. I'm not telling the banks, but I'm going to like really kind of renovate this property in a big way. That's nowhere on the application, so they don't have to know I can qualify. I guess the banks don't care that I'm going to take this thing down to the studs or remove some walls or whatever the case may be.
Yeah, like, if you're not really telling them, then there's nothing really to say, right?
Well, they don't ask on the application process. They don't ask.
Exactly, right? So now I've seen on the application process, a lot of people don't see. The bank always wants to know a reason why you want. If it's a purchase, it's a little bit different because you need the money to buy a house. But on a refinance especially, it's why do they want this money? Where's the money going? So there's always something that has to be explained to them as to where your money's going. So it's something they want to know, and it's just being able to kind of fit their mold of what they would like to lend money for.
What are the rules? If I have a mortgage for 5 years and then I knock down the property because I'm going to rebuild on it, what's the official rules on that?
So if you knock it right down to the ground and they find out, I've seen them get pretty upset.
Oh yeah.
And if they, again, I've seen it a lot of times where they just never find out because no one's really driving by your house. But if they do find out, I've seen them get pretty upset and basically not let you renew when that renewal comes up.
But there's no official rules around that. Is there a clause somewhere on the mortgage that says that you can't knock down the house to rebuild it? Oh, really?
Yeah, they won't be pretty happy with you if you all of a sudden put it right to the ground.
And then that relationship is just kind of.
Yeah, I figured that.
Yeah. But they will most of the time if they find out, which not obviously a lot, but they will just basically say, okay, we're calling the mortgage, and sometimes they'll let you at least last to your renewal date, so you have some time to find it. Or sometimes they'll kind of.
So then I wouldn't say that we have a property with a small mortgage left on it that we're probably going to knock down and build something else on the lot. Like that would be a silly thing to say, right?
Yeah, I wouldn't tell them that. Yeah.
So I won't say I won't say that on air. Let them find no. So the reason I'm asking is because for you guys, I'm just thinking that you get involved with an investor who wants to renovate a property, rips it down to the studs, and then I don't know, the guy's got a gambling problem.
That's the biggest risk that we face is when they get into construction and there's a life event. So historically, these flip loans are our lowest loss ratios, our lowest loss provisions.
Oh, really?
Yeah. Like even in this market where in Ontario, we've seen a massive swing in values.
Sure.
And that's where that creates risk too, right? Like they buy at X and in 6 months later, it's literally worth 20% less. That's a risky scenario, but even more risky is when there's a life event, gambling, addiction, divorce, something where the project goes off the rails and they don't complete.
Loss of job.
Yeah. And those are the ones where we may lose. But luckily, we have a network of investors. We have a network of realtors, a network of brokers. And when there is a default, we work with the borrower to try to protect them, in turn protecting us.
Of course. No,
right?
I mean, like, business is business too, right? We got it.
Yeah. So as long as they're working, we're going to try to figure out a way to minimize the damage. And sometimes they don't work with us, and we have to use the in Ontario, it's a power of sale. But again, typically they bought all right. And we have this network of people. Again, the hardest part of this is finding the property. So we have this network of realtors and brokers and investors and say, hey, here's an opportunity, and we'll take back the financing even. So we're really good at solving our own problems.
Yeah, because if it was a decent purchase to begin with, and there's a network of investors, then it's likely that another investor will pick up on it and and move forward with it from there, right?
Yep.
Exactly.
What's you said power of sale in Ontario? What is it in Alberta?
It's a foreclosure.
So it's quicker.
So the difference is significant. So the easiest way to put it without getting into the weeds is in Alberta, the process takes, I'm going to use broad strokes.
Okay.
Yeah. Process takes 6 months from start to sale on average. Sometimes
starting not missed payment, starting the actual foreclosure process.
Like, you're 3 months in arrears, you're not working with us, we got to move forward with foreclosure.
Yeah.
So 6 months and about 10 grand in legal fees and multiple visits to the court. Whereas here in Ontario, it's 2 to 3 months, half the timeline and half the cost. You don't have to go to court. Send it to the lawyer, and we can list
opposite with landlord tenant board versus your guys.
Very much opposite. I think landlord tenant board for us as a lender and our borrowers is a bigger risk. Like we've seen some projects really fail because they anticipated to get the tenants out and they weren't able to.
Well, ours take forever here.
It's a nightmare in Alberta. It's a nightmare.
It really, my understanding in Alberta is when a lease came up for renewal, that there's no rent control. Is there at one point there's no rent controls?
No, there still is no rent.
So, but then you could just raise the rent $5,000 a month, and they're going to leave.
Whatever. Yeah.
Right. So, but isn't that how you can get someone out if you need it?
In Alberta, you can get them.
Oh, you're talking about getting people out in Ontario.
Yes.
In Alberta, it's very business forward. Like, you're not paying, you're out. You want to renew, market's gone up. The landlord can increase the rents.
So how do you get someone out in Alberta? Like, let's say I'm a tenant. The first comes and I'm like, I'm not paying. I don't have money. I'm not paying you. What's the process?
Depends on your lease too. Like if they're not paying though, you can just kick them out.
Well, how do you kick them out? You need some sort of court order or something you can't.
Oh, like they literally won't leave?
Yeah. Well, yeah. Like I'm a non-paying tenant.
Yeah.
I've decided that I'm not going to pay you.
Yeah.
And I'm just going to ride this thing out until I need to leave.
Yeah.
How do you guys get me out?
Authorities would come and drag you out.
No, but
how fast? Though?
You just call the police?
Yeah.
No. How do you evict someone? What's the eviction process?
Call the cops.
No, really? I got to look at
no way.
I haven't gone through this.
Okay, yeah.
And none of us have
rentals
really at Calvert. So
we got a lot of people with rentals on our team.
Yeah, but no one's had to go through the eviction process.
Yeah,
not that I've heard of.
No, I know. That's why I've got to look into that. I'm curious how it is
because it's that easy, right? Like it seems like we don't hear about it because they can kick them out with no problems, and that's why a lot of Ontario people are coming to Alberta and buying property there.
And that's my understanding. That is my understanding. It's substantially easier, and that's why the power of sale process is funny. Not funny to me, but it's
a little backwards.
Yeah, because typically Alberta is more. A lot of the laws, even tax laws and stuff, favor
business forward.
Yeah, right. Versus we're very. We seem to be falling more and more backwards.
Yeah,
maybe not. We've done some. Toronto just came out yesterday, and they just approved higher density, like across the city, which is like I think they're the biggest city by far in North America to do that. I believe that. No one quote me on that, but I think that's the case. I have to look at it. It might not be North America, Canada for sure. But so they're finally kind of realizing like, hey, we got a bit of a problem. We kind of got to change some stuff here. They are trying to fix the landlord tenant board. They're hiring like a ton of people to try to fix that process. Because at one point it wasn't too bad. Like by the time from when you filed to when you could get an order to evict was about 6 weeks. Right. So it wasn't that bad. And then just this backlog just got longer and longer and longer. And now it's like, I don't think it's 6 months anymore, but I think it
still takes pretty long.
Yeah. I think it's about 5 to get in front of an adjudicator. You're in between 5 and 6 months right now.
Right. But then even the appeal process isn't like, from what I've read and understand, it's relatively easy for the tenant to appeal and say, no, here's why, and then drag it out another X amount of months.
Then they can pay. So if they'll give you like catch up, even though we all know they're just going to miss the next 8 months again, they can keep playing that game for a while.
Yeah, they can. The appeal for non-payment of rent, it's pretty cut and dry.
Okay.
So but usually so they can, if they catch up, so they can put on a payment plan. And if they catch up, then they get to stay. And then even if they know they're going to miss the next 3 months. However, they have changed some things around it, that if they have a payment plan and they falter on that, or they catch up, and then you can just kind of reimpose another payment plan. Or like it speed things up a little bit, but it's still not. It's not great, So yeah, it's an interesting. It's kind of, it can be kind of messy, right? And it was like I said, it wasn't that bad. COVID, when they just shut everything down, that didn't help anything,
right?
But you guys have seen, I guess, your rent amounts, and I guess this is goes back to your lending, because in Alberta, my understanding is the rents will fluctuate greatly as well. Like when you guys had a big downturn in the energy sector, because we're Canada and we don't want to invest in our energy sector.
Yep.
We just want to leave it there.
We want to pretend this economic opportunity doesn't exist. And that people don't consume natural resources.
No. Why would we do that? Although we will take some of it now and again and just sell it off to like a foreign country, because we don't want to benefit from it. So, and then they can harvest it and sell it back to us. So that's good. But it's really smart. We're good. We're good at economics in this country.
Yeah.
But when the energy sector did get a downturn, I think rents, because you don't have rent controls and they can jump fast, they can also come down as well, right?
Yeah, absolutely. It's market forces is what we see.
Yeah. Whereas in Ontario, ours are like artificially suppressed, so we don't really see them come down, and that's historically, even in multiple areas where they're like that, we don't get the ups and downs, but it's just the slow and steady approach, right? So, but isn't that what percentage of your business is like in Alberta? Where are you guys primarily? Is it like Ontario, Alberta? Yeah, no BC?
Not yet. We're building out the plan to go to BC, but we still see some things that we can do better in Ontario. So we want to make sure we have the business dialed in from a service standpoint, from a risk standpoint before we expand. But right now it's Alberta and Ontario.
And Ontario being
this time last year. Now keep in mind, we've only been in Ontario for 3 years.
Yeah.
This time last year, 60% of our business was in Ontario, 40% in Alberta. We've inverted that because the real estate market in Alberta has been strong. So right now it's a 60-40 split for Alberta versus Ontario. But when we have Ontario fully captured, we should be doing 4 times the business in Ontario.
Got it.
And when you say Ontario, Alberta, is that like the province of Ontario? You guys like GTA more so, or what's like the location lending base?
Oh, the province.
Yeah.
Like the full province. But like we like to stick closer to the urban centers. But we're all over. Like we go all the way up to Sudbury and Sault Ste. Marie and Windsor, and so we're all around, but
yeah, so tiny little towns, maybe not so much, but anything with it's got some sort of population, employment, and that type of stuff.
Yeah, anything where when we look at the economy, we say, this is an economic center where there's employment, people will want to live here, and in turn, housing, there's some housing stability. That's where we want to play. We also are very much focused on the mid to lower half of the market. And that's kind of that's where our investors are focused too. But from a risk mitigation standpoint, mid to lower half Canadian residential real estate doesn't move as much in an economic downturn. Like the high-end stuff usually gets compressed. There's always a floor to housing. So that's where we like to focus. But ideally, we're lending in centers with 50,000 people or more.
Got it. Yeah, that's been our investment approach too. Just we like this. We don't just do the single family kind of starter home market, but we like that market because, to your point, in any real estate market, no matter how low or high price, that entry level segment is like where people are moving up into it and people are moving down into it. It's the most liquid asset when it comes to real estate. So especially for you guys, if you have to take back a property, you know that you'll be able to sell that, you know, might not know the exact price, but you know that there's going to be demand, especially with today's kind of the way today is, there's going to be demand for that property, right?
Yep. Yeah. Like in this downturn, we've had to sell 5 properties through power of sale in Ontario.
Yeah.
Over the last 6 months. We've only had 5 power sales in Ontario. We've lent on hundreds of properties.
Yeah, I was going to ask you, is that good? Do you guys look at that as good? Bad? Yeah, you feel that's been solid, considering what we went through in the last year. You guys feel that's solid?
Considering what happened, we are very happy with those results.
Yeah.
But more importantly, how liquid the properties were. So we go to power of sale. You're dealing with these properties that are unfinished, and we, in most instances, multiple bids. In most instances, we were out within 30 days. So our thesis on lending on that mid to lower half proved itself out in a really poor market. Like this is almost in the last 30 years unprecedented for Ontario for it to drop this quickly, this much.
Yeah.
And our risk, our underwriting really kicked ass through it. So
yeah, that's cool.
Yeah,
that's cool. That was a pat on the back for you, Garrett. Yeah. Well, we had that huge run up, right? And that's why a lot of people went to Alberta, because everyone got the run up, because when the government floods that much money into the system, you know, that's why lumber, beef, like, you know, the prices of everything were skyrocketing. But we were up. I think we were up 50 to, like most areas in Ontario over a 2-year period, we're up 50 to 60%.
It was insane.
It was nuts. And now they've come back down, but they're still up. Probably last I checked, it's probably about 9-10% over that period, like a yearly, you know, increase over that period. And our long-term average, so we went back to the Toronto Real Estate Board. We went back to, I think the data we could get was 1969. And we looked at the average yearly increase from 69 to, at the time we did this was the end of last year. It was like September of last year. And when we looked at the average yearly increase, it was just over 7% annually.
That's nuts.
And I thought it was low. I thought it was actually closer to 5. I was expecting it to be closer to 5 because I was always under that impression, but it's actually 7. And it didn't increase. So then we thought, we're like, okay, from 2008 onwards, really skew these numbers. So we took out 2008 to 2020, mid 2022. And then, the number wasn't that much different. It was like high 6, it was like 6.7 or whatever. And then if we looked at just what 2008 to 2022 was, it was, you know, 7.4 or something like that. But anyways, so we're right around, even without kind of what we've seen with kind of these low interest rate policies, we're still a high in between 6.5% and 7% year over year. And that's through ups and downs and everything, right, over the long term. So, but in Alberta, are you guys, so what happened here? So you guys are from like, familiar with a lot of the areas.
Yep.
Toronto. So a lot of money came into Toronto. Affordability got challenged. A lot of people were leaving Toronto, going to these other areas like Hamilton and stuff. And then people looked at these people from Toronto coming to Hamilton. They're like, these jerks, why are they coming here with, you know, these higher incomes? Now they're pushing the price of real estate up here. So there has been more people from Ontario looking at Alberta because they didn't have the same run up in prices, although they've held it now, and they've had increases when people had decreases in other parts of the area.
Yep.
Do people from Alberta now hate people from Ontario even more because of this over the last year?
I don't think so at all.
No.
I think we welcome it. Like this is helping our market.
I don't know if you walk, because whenever I've been in Alberta, they're like, "Oh, you're from Toronto."
Well,
that's the personal side. For the real estate market, we're welcoming.
Oh, all right, okay, I got
it. And even I would think that dislike may come from what we talked about earlier with the political point of views and the fact that federally the country is not supporting Alberta like it could.
Yeah.
Which is, for a lot of Albertans, a really shameful thing to happen. But from the standpoint of people coming to Alberta, our province is has been a boom province for a long time because of people coming. And today,
so it helps then.
Today there's a lot of jobs open. There's a lot of talent coming into Alberta, particularly Calgary and Edmonton, and most of us welcome that.
Okay, and what industry? Energy again?
We're seeing energy always, but not
our
nearly
tech
as much.
industry is getting better too.
Yeah, I've seen that. I've read a couple articles on that too. So you're seeing growth in that area as well.
Yeah, we have a tech hub. We have a lot of very smart, educated young people in Calgary and Edmonton, and that kind of grows itself, right? So offices are half the cost of Toronto. You can live in Calgary, the furthest outside of the city, in the suburbs. You could be downtown in half an hour. That house in the suburbs, single family house with a 50-foot front lot, 150 deep, is going to cost you 500, 600 grand.
Yeah.
And we're an hour away from the mountains. So cost of living is really great. Like when we're hiring people, we see a lot of really talented people from Ontario applying because they have a desire to own a home, and they can't, the likelihood of them accomplishing that, staying in the GTA, is much lower than coming to Alberta. And not to mention, our earnings in Calgary are higher than that of, like, our average earnings are higher than that of Toronto.
Home, yeah.
So, and our income tax is lower. We don't have PST. I guess it's HST here, so we pay 5%. So there's a lot of things happening that are driving young, energetic, educated
Makes
people
sense.
to us.
It's game theory, right?
Yep.
Like and we're seeing the numbers of people leaving Ontario are growing. I think it's an all-time high. I know it's an all-time high in the last 20 years. I haven't gone back really further than that, but they're growing. We're just getting so many more people in that even though the numbers of people leaving, it doesn't, like, our growth, overall population growth is still jumping. But it makes sense. Like if you can get in a good opportunity and elsewhere, there's a lot of people, even during COVID, we saw people going out east and all sorts of different places.
So in the real estate market right now in Ontario, what are you seeing?
Yeah, well, for a lot of us, a lot of people are kind of, the single family and the duplex are doing like pretty well. Obviously, still sales wise, like we still see offers come in. I'm sure you still seen, like Nick's still seeing multiple offers on properties like that. A lot of people are also reverting to like commercial and things like that now, just to try to keep finding ways to make those numbers work. So it's been obviously a lot of new constructions coming up still. So it's a little bit of everything, to be honest with you right now. But still, there's definitely lower transactions. I'm sure Alberta's the same way, very low transactions. But then tons of people
no supply.
No supply.
Issue, I think,
on our end, on our end, we're pre-approving like over like almost 200 people, 250 people a month, and just that's not yet. Just so the pipelines are getting really big because everyone wants to do something. Just no one can do anything right now.
Yeah, I'd say the last 60 days we saw the like from whenever it was November through February, call it, or something. It was a lot of people had their hands in their pockets and they were just like, hey, let me just see where the dust settles here with these rate hikes and stuff. And then once they got the impression that okay, we're kind of reached the top here. And even if they raise another quarter point at this point, as a percentage, it doesn't really impact things, right? Yeah. And then people started coming out of the woodworks and be like, okay, now I know where things lie. They got to do something. And a lot of people, the investors that we work with, they're just, the numbers are tighter on the properties, but they're still they still want the asset because they're seeing what's happening to their purchasing power of their savings, and they're like, what? We know people that have sold their businesses recently, and they said, okay, this was great, but now what the heck do I do with this money? Like, I can't save this money. Like, I need to invest it someplace, because if I don't, it's just the value of it just disappears.
Inflation's eating it up at 5% annually now.
Yeah, and that's if you actually believe the 5%.
Right.
But if we look at the things that we want in life, like the things we need. So if we look at energy, we look at the cost of, food, and, I'll look at meat primarily. And I know some people don't eat meat, and I mean, good for them, I guess. I feel sorry,
More for you.
I have no problems. I'll take double the share. No, but that's fine. But if you look at protein, it's just the cost has gone up. Right. And it's just like, it's not going up 5% a year. Like no one's grocery bill has gone up 5%. So it's a little bit of kind of it's fake math. The debt is growing by 8% a year. So if they're growing the debt by 8% a year, that's money in the system, and we know that that's growing by 8%. Then we know that the inflation's higher than that.
Theoretically, it should be 8%.
Yeah,
the value of our money should be going down at the rate that they're increasing the debt.
Exactly. So it just doesn't. Yeah. So that's why. So we're seeing investors are like, look, yeah, you know what? I should have bought 5 years ago. I get it, but I still, for me, for the next 10 or 15 years, I want assets in my name. And because I just feel like this asset inflation that we're seeing because of the economic policy that we follow is important, and that's kind of been their priority.
And still to me at least, pretty clear that real estate's still the best option of all the asset classes you can buy. It's still the safest option, and obviously proven to be the best option too.
Mm-hmm.
Yeah, it was
changing that.
It was just unfortunate for those that bought from that January to April period. But since then,
but even then, wait 5 years, 5 years,
exactly,
back, right?
Exactly. If you can afford it and hold on to it, great. But now, like, things have tailed off. It's very balanced again, it seems like, and there's just not that much supply.
Yeah,
so.
You're right, because from I guess like November 21 to Feb 22, and you guys saw it too. You must have seen it in the underwriting department. You must have been like, what the hell's going on with these prices? Because prices literally went straight up, and then they came back down. The good news, I guess, is that there were, relative to other times in the past, there were so few transactions going through because there was such a supply shortage that was causing the prices to jump, that there wasn't this whole whack of people that really bought right at that peak. Like, it happened so fast and then it came back down versus, so like if you look at the actual TREB numbers, 2022 average sale price was actually up last year over 2021. Even with the drop in prices, because the peak happened so fast and then came back down. Yeah. So it was like a weird dynamic, right? If you're an underwriter, you must be a numbers guy. Yeah. Do you look at that type of data too, or you're just more focused on the individual properties?
Yeah, we do our monthly economic reports too.
Oh, okay.
And being able to have realtor access and get the data, we can do those economic reports even better.
Yeah, so you can see it a little bit more in depth.
So yeah, we'll get more and more into the details about the economics of Ontario, and we already do in Alberta, but for sure we look at that, and that was a crazy drop off. Like it was so quick. It was
and
so quick.
The peak was crazy too. Like the run up was like, it was those few months. I was like, what is happening?
Yeah, and the mindset going into that too was, before it happened, it was like, well, I can't lose money. Everyone in Ontario was thinking, okay, well, everything's just going up all the time, up. And so when we're doing our internal values, we base it on specific data. When some people were like, oh, well, the market's still going up like crazy. Like, I can inflate my number on the back end even a little higher.
Yeah. Like realtors and brokers and borrowers were literally telling us that you have to add in an appreciation factor. And we say, no, we're valuing it at today's dollar.
For sure.
If there happens to be appreciation, great for you, but we don't speculate here.
Yeah, especially, like you said, especially on a short-term 6 months, there's no major, under any normal circumstances, there shouldn't be no really major appreciation going on at that
or
time.
Depreciation for that matter. Yeah. And that's why we love that short-term stuff. But back to your question, we're very much data-driven, and we're looking at leading and lagging indicators, micro and macro, and really it's supply numbers, really it's what HPI is doing, days on market. So today, similar to what you guys are saying, we're very comfortable with most markets in Ontario. We've seen prices level off. We see the fundamentals as it relates to inventory be strong. So we're really excited to support borrowers and investors in Ontario and deploy capital, and we're well supplied too. So
not even on just the real estate investing side either. Like, we want to help all clients with short-term purchases and stuff.
Bridges,
as you know, like, there's a lot of times where the banks just last minute, there's a condition that they just can't meet, and they're like 3 days before closing, and like, okay, I need a solution, and we can be that short-term quick solution for clients.
Yeah, it is nice. It does fill a gap for sure. Yeah. Let me ask you something. I want to go back to something though about Alberta specifically and energy, because this blows my mind. And we've had a guy that does a lot of multi-unit stuff in Alberta, Pierre Paul, on podcast a couple of times, and he always gives us the ranting. He's a French Canadian originally, and so he's got the French Canadian rant going all the time about Alberta and stuff. And it blows my mind that we had someone, so I think it was one of the German ministers came over looking for LNG, like liquid natural gas. And we basically got turned away by Trudeau and just said like, no. And then they signed, it was only a matter of weeks later, they went and they signed a deal with someone to buy, I forget where they're buying it from now. And
probably somewhere in the Arab world, or Russia,
or it's the they didn't sign it with Russia, but what's happening now a lot is it's the Russians are selling it to like the Indians are reselling it to Europe, and they're just paying more for it, and it's going around, and I'm like, this is crazy. But
a form of social washing.
Right? Exactly. Yeah. So when that type of stuff like happens in Alberta, when you just see this opposition to one of the industries that can be beneficial, and I look at it, I don't think just for Alberta, I think it can be beneficial for the entire country. Like selfishly for someone in Ontario, I'm like, well, yeah, okay, let them benefit, it's there. But overall, if they're benefiting, we're all benefiting. Like this is just growth for everyone. What's is it just for like, you guys just get like overall, is it just pissed off or what? Like you're from Ontario, what took you to Alberta?
Work.
Oh, okay.
I finished university and I wanted to trade, and there was.
And how long ago did you go there?
I moved there in 200007, so I've been 16 years.
Okay, so you're long enough to get pissed off too. That's why I'm wondering.
I look at myself as an Albertan for sure, and it is wildly frustrating. I'm surprised that the frustration hasn't showed more in our politics, although it's starting to. Like we're likely to elect a conservative leader again.
Oh,
and
who's likely?
Alberta is.
Federally?
No, Alberta is.
Yeah.
But this conservative leader has already brought up leanings towards secession.
She's got some pretty strong statements. Yeah, for sure.
But looking at it macro, like world leader type stuff, there's this gentleman, Peter Zehan. He's a demographist, economist, and he wrote a chapter on the Alberta problem and predicts that the divide, unless we fix it as a nation, will continue. The fact that Alberta is this economic engine that's being thwarted federally, and at some point, the people of Alberta it's going to become an issue federally. Yeah. I think so. These transfer payments, Quebec looked to leave. And then we bribed them with transfer payments. Yep. And now Alberta is being sucked dry with these transfer payments. And Quebec almost created the path to leaving. So it's something that we have to think about. And I'm surprised, like I know Garrett and I are very much federalists. So we're happy Canadians, but...
Yeah, but sometimes you're like, it's, I like, if I'm part of a group, I'm like, hey, this is a great group. But if all of a sudden the group starts working against me, I'm like, hey, I don't feel like I'm as part of this group anymore, right?
Yeah.
No words.
I don't.
No, it's so weird though, because
it's frustrating. Like it's like we have all this oil in Canada and we can't get it across our country. So, and people are like, oh well, we'll just deal with. We won't have oil. We can get it elsewhere. Where do you think it's coming from elsewhere? Like our oil is some of the cleanest. Like we're one of the cleanest countries.
We're shipping. What's funny is we're shipping in oil from Saudi Arabia.
Exactly.
So even for
that clean?
So even for the environment, if people are using the environmentalist kind of argument, it's like, well, I mean, you gotta kind of look at the whole supply chain when you're looking at that. So yeah, it's funny because the dynamics of Canada when it comes to, if you look at the map with how people kind of vote, the cities are very different from the vast majority of the country. And just the electoral system. I mean, Trudeau last time got in, it was an all-time low support for a prime minister. I think it was 32 or 33%, something like that. And I'm like, wow, so we're voting in a leader with 32%. Like that seems like, I feel like the systems are like our election system's slightly broken there too. Something's not adding up to me. You know? So like, how low does that go? But anyways, okay. So we're
not going to solve that here, but it is it is definitely something that we as Canadians should have on our radar.
Yeah, for sure. Well, the reason I'm asking and looking at it is because there is, like, if from an investor perspective, there is growth opportunity in Alberta, and if you keep your eye on that trend with that, like if some things start changing in the way people look at that sector again, there then becomes a lot of opportunity in Alberta. If that ever changes and the mood towards the energy sector changes. And I think that's why I'm looking at it, because I look right now, the condos going up in Calgary, and there's demand for some investors going there and stuff. But I'm like, in some other areas around here, we've seen that story before, and I don't know exactly the housing dynamics there. So I could be mistaken here, but sometimes it's just like those products were forced on us in areas here where there wasn't really demand for those in the past. And that's why I'm not sure where that lies in those areas. Short term, there can be demand. And I just don't know what kind of population growth you guys are seeing and what kind of housing,
We've never seen population growth that we've seen in the past year in Alberta.
So you guys are seeing the same thing then?
Yeah. And
primarily from
Ontario?
International or
No.
within Canada?
It's mostly interprovincial that we're seeing.
Yep.
Because what we have seen typically is because of the infrastructure and community here in the GTA, immigrants will typically land here first. It's just there's the infrastructure, there's the family, there's the support systems, and then you'll see them migrate to opportunities throughout Canada once they've assimilated and kind of have those needs met.
Yeah.
But even what you were saying about if we as Canadians start looking at energy different, but what's happening also in the energy sector is these same companies that are taking fossil fuels out of the ground are also investing in renewables. So like the geothermal, the hydrogen, the wind, like all of that.
Don't talk to me about wind.
Regardless,
we're not allowed to talk about that.
Regardless, all of that engineering, all of that design, all of that brain power is happening in Alberta. So it's likely that we transition, but that transition is going to take 40, 50, 60, 70 years. Yeah. So these companies and these individuals want to be at the cutting edge of it to ensure that that if and when fossil fuels are no longer existent, they can transition to it. Yeah,
I was joking about the wind because I see those windmills 75% of the time they're not even spinning. Yeah. And when you look into them, I'm like, I just don't understand that. These things don't do anything, best I can understand. But anyways, that's a whole other conversation. Back to the mortgage side. Funding. A lot of investors will come to us, they're like, and a lot of investors don't realize, I think, how much money is available. So from, I guess, both your angles, so Lorenzo, from your angle, and then from you guys, if there's a decent deal, I'm not talking this like, needle in a haystack deal, but a decent opportunity, is there ever a problem finding funding for a decent opportunity? Do you guys have ever seen that?
Not really, to be honest with you. Like, if you have a good deal, the location's good, especially with the location's good, like that opens up the doors for a lot of people. Where you run into problems if you're buying the property that's half apart, half together with someone with a poor credit score, borrowing history in a random location, right? But if it's something where it's a good deal and good, especially good location, putting the actual borrower themselves aside, it's very tough not to find the money somewhere for it.
Yeah, the mortgage brokers have all the options. Like, if they can go to multiple different sources, they know all their lenders, and usually there's lenders out there with capital. From our side, we have lots of capital right now, so we're looking to place more and more in that short-term mortgage lending.
What do you guys look at when it comes to, so I'm the investor coming to you, and then you said you wanted a detailed rental plan. Because how do you know that I'm going to be able to kind of complete this? So I guess credit score is a big one. You want to see that I can manage money, right?
Yeah, for the most part, like it's over 70% of our clients right now are over a 650 Beacon score. Okay. So they're good clients.
And then what about the reno aspect?
But we're getting to know the investor intimately. So Lorenzo brings us a client. We're unique in that, great, Lorenzo, we want to support Joe. Garrett's going to get on the phone with Joe and he's going to say, hey, Joe, tell me about your plan. Who's going to do the completion? Oh, you're a carpenter. Great. Who's going to do the plumbing? Oh, you got Buddy doing the plumbing. Okay, so your reno budget makes sense. You've thought through it well.
That doesn't terrify you, though, if they're going to do it themselves? Because what if it's just some hack job?
Yeah. Well, so we also look at their past history.
Okay.
So we like to see, hey, have you done other projects? Like, could you send us some photos? Or maybe you have an MLS listing of one that I can check out online.
Okay.
And be like, okay, this is quality work. Talk to, hey, have you done... Have you done it yourself in the past, or do you do it through contractors? And have you qualified those contractors? Like, it's a lot different when you're dealing with a first-time real estate investor or one that's historically done a bunch of them.
Got it.
Yeah. And how do you guys look at those? Like someone comes in, hey, I own my current home, I got some equity in it, but it's the first time I'm going to buy a property and I plan to flip it, and they're very green. How do you guys look? Are those, hey, just put more down payment, we'll kind of be able to guide you through it, or how do you guys look at those?
We're big on education, for one. So we'll definitely talk to them about, hey, have you done all the steps that you need to do to ensure you have the right plan, right team in place? Like if they're doing a BRRRR, do you have a mortgage broker in place? Do you have a good realtor on your side who can get you the right property? So we go through all the steps with them over the phone, talk about their plans. Like, have you vetted your contractor? Like, we know how important that is. Like, we've seen contractors skip on properties and costs go way up. So they have to have a plan and contingencies in place to make sure they're comfortable. So when it's a first-time flipper or a first-time real estate investor, we're doing a lot more conversations and talks on the phone about their plans and making sure they're set up.
Yeah, and to that point, Nick, our best borrowers have historically been the tradesmen, the guys that are coming in with paint on their jeans and, sawdust in their hair. And they know what to do. They can solve their own problems again. And now typically those same contractors will evolve into project managers and be able to know all that. The scary ones are when they watch HGTV and they think they can do it, and they call Joe one call, like not multiple quotes, one call, one bid. Yeah, let's go, let's do this job. And they haven't thought it through. So we want to work with the people that are entrepreneurs, that know their numbers, that have quoted it out 3 times, that know exactly how much a square foot of drywall is going to cost them plus the paint. So that's the work that Garrett and his team are doing, is really understanding who is this borrower, what is their likelihood of success. Now, the green people will still work with, but as Garrett mentioned, he'll just do more work with them. He might check in more often. He might ask a couple extra questions. He might point them into, hey, maybe you should talk to this renovator. Maybe, you don't have a realtor who understands real estate investing. You might want to talk to one of these 3. Like, we'll just take the approach to put in the extra effort to hopefully increase the likelihood of success.
What's the hardest part for you guys? That sounds like, to me, the hardest part in the lending, because finding out about the property seems easy. The numbers seems kind of easy, but it's understand, because when you have to understand the person at that level,
in that short of time too.
Because the banks don't get into any of that with this person. They're just looking at this person on a piece of paper. That's all because they're not looking at...
There's no project, right? So the bank's looking at it where, does this person fit my debt servicing? If so, all right, great. Nope, move on to the next one.
I don't like the banks.
Yeah.
I don't say that. If I'm actually applying for a mortgage right now and you're at one of the banks listening to this, I actually really appreciate everything you're doing right now for me. Until it funds, then we have a problem. No.
Yeah. No, it's all character based. Like, that's the toughest part. We need to ensure that they're qualified borrowers. But part of that, like, there's a bunch of different pieces to it, right? Like, you got your stuff that the banks would get. We get the same things. We get credit, their notice of assessment, make sure they're paying their taxes. They got funds. They have history of doing these renovations, stuff like that. So just qualifying that. But once we get to that point and they do a successful project, we've made that relationship and we can just keep going.
Second, third, fourth, and keep going.
Yeah.
What's brilliant is most of it is repeat business.
Yeah.
Repeat business, and they're coming back, and then it's an easier qualification process, right? Because we know their work. They were successful. So let's move on to the next project and make some more profit.
Yeah. Then it becomes more just about the opportunity, because you there's some trust being built with this person.
Exactly.
Yeah.
Rinse and repeat. Garrett works with some clients that literally, here's the budget, here's the house, snapshot of the bank account, turn it around, same day, fund it 2 days from now.
I think one of our clients in Alberta has 20 projects on the go right now. 20 flips.
On the go?
Yeah.
Wow, that's a lot.
Yeah. And most of the qualifications just, hey, what's the rental plan? And honestly, with their rental plan, I already know. Our evaluators internally know, because we've seen so many end products that we can just say, hey, this is what it's going to look like. This is what it's going to be. And we can evaluate it and say, hey, yeah, you're good to go. You have the money. Let's do another one.
You could literally go on Calgary MLS and say, oh, that's his project. Because every time know his design, his paint, his lighting. Like, he's almost like the we'll call it the row home builder, but doing it from a flip standpoint. He he's
Well, yeah, if he's got 20 on the go,
systematized
exactly. He or she's got just what they do every single
Crew doing it all the time.
yeah.
Yeah, from one, and they can use the same crew, move from one to another.
Exactly.
Yeah, he's put it in place.
3 or 4 crews that go one to the next, and
He's a general contractor.
Exactly.
He's just taking the upside. He's taking the upside on the property instead of just doing it for other people, right? And then when you can implement your own systems, it's easier than dealing with the homeowner, because the contractors I know, they're like, holy cow, man, they can't decide on their tile, that grout color. I got to talk to them for an hour and a half about the grout color. It's just like pick the, So these people just know they have the same 5 things they use and they throw it in there. Exactly. How'd you get into underwriting?
That's a longer. Actually, we have a pretty funny history. But I was supposed to go back into oil after I came back from university, and I told my boss at the time, hey, I'd like to go to Australia for 3 months, and did that, and oil crashed. And he's like, okay, well, we don't have a job for you anymore. So, and my dad actually happened to be an investor at a different mortgage lending company in Calgary. And Jesse was one of the partners there, I think. And he hired me there. And then...
Oh, funny.
So Garrett's dad and I did a lot of business.
Yeah.
And then I think 2 months into me being there, Jesse pulls me into his office. He said, hey, I'm leaving. I'm like,
here's the master plan.
I was like,
on it.
Get out of here. And they're like, no way you're leaving, because everyone else is like older here. You're the only guy like close to my age. Like, come on. And so he left, and I stayed there for about 4 or 5 years, and then had a falling out. And then they were looking at Calvert for another underwriter and hired me again.
And that's you left there to Calvert directly?
Yeah. So Garrett and I worked previously at a syndicated mortgage lender.
Okay.
And what a great way to learn underwriting. What a great way to learn real estate. Because what we were doing there is we were going to the market and saying, here's the type of capital we have. Mortgage broker would send it in. We'd package it up and send it to these wealthy people. So let's say I needed $800,000. I'd package it up, the due diligence. I'd give, kind of like investment banking, give my summary and send it to 10 guys and say, I need $800,000 first come, first serve. And these 10 guys or gals would call and they'd question this and question that. But I'm learning from these business people who have decades of experience. And this was during the mortgage crisis I started it. So anyhow, Garrett and I were doing that I did it for 8 years before joining Calvert. I've been with Calvert the last 8 years. And Garrett did it for the first 5 years of his career. And now the last 3 or 4 years.
Oh yeah, so you get the experience. How long have you been at this, Lorenzo?
5, 6 years now. I started when I was like 17, so...
Yeah, he started. Wow. Yeah, we basically, it was like, I'm not going back to school. And everyone around him was like, hey, look, I think you just go get that piece of paper and finish it off. But I think that the last year for school for you was tough to get.
All 4 were pretty tough. Yeah. The last one was bad.
Well, if you're that type of driven person like you guys do, you see opportunity. You're just like, man, like I feel like, I started... My first job out of school was at the municipal government. So the region appeal, and I would leave there, frustrated all the time. And people are like, I don't get it. Like, why are you so pissed off? They're like, you got the government job, you have this pension. Like, this is great. That's kind of what people want. And I'm like, I'm wasting my time there. Like, I can't do anything. Like, it's chewing up so much of my time. So I'd imagine at school, that's kind of
same idea.
Like, oh man, I just want to get this done.
What are we doing here?
Yeah. So cool. So what's the process? If people want to learn more about any products, they reach out to you. Like, where should they go to kind of reach out to Calvert? Do they reach out through a broker? I know they can contact Lorenzo.
Yeah, we Calvert all the time, so you can always contact us. We do a business together, and we can definitely go that way.
And they can check you guys out where?
Yeah, just on our website, or we have some good Instagram handles and Facebook, and we're on all the social media stuff. But yeah, for sure, we deal with a lot of mortgage brokers too. So
I understand the mortgage brokers are the conduit to you guys primarily. Exactly. You want to respect those relationships, 100%.
Definitely.
But everything we do is education. So if you check out our website, it's all going to be about educating the borrower to be more successful.
And that's what CalvertHomeMortgage.com.
CHMIC. Calvert Home Mortgage Investment Corporation.ca.
Okay.
CHMIC.ca. Just look up Calvert Home Mortgage on Instagram, and it'll again be all about educating.
What do you guys put on Instagram?
We do a ton of case studies, like before and after. People love it. Tips for flips, what to watch out for, design ideas.
That's kind of cool.
We have 3,000 real estate investors, and we'll say, hey, check out the podcast we just did.
Yeah.
So stuff like that, where we're truly providing some value through education. And we'll post stuff on YouTube as well. But yeah, you can. That's where you'd find us.
Cool. And then you guys are here in town for a couple of days. You came out. You're going to a Jays game. You're not going to a Leafs game because you refuse to root for anyone, any other.
No. I just not Edmonton. Just not Edmonton.
Not Edmonton. So it's like
Toronto.
It's like us with the Habs.
Yeah, exactly.
Yeah, Toronto. Like if they're the last Canadian team, maybe you throw 15% of your support that way, just cause. You know, well, that seems like a stretch. Yeah, that seems like a stretch. McDavid though, but you have to respect McDavid, even though he's on Edmonton. You have to respect that guy.
There's no doubt. I just wish he wasn't there. He wasn't supposed to be there. He was supposed to be in Buffalo.
Well, you know what? The same thing about Edmonton. Nothing against Edmonton fans, but I got to be honest. They had how many first-round picks in how many years?
Exactly.
To have that many first overall picks in that many years and still be as deficient as they were this long period of time, you know, like I want McDavid to win 100%. That guy to watch, it's like watching a video game with the things he does. I want that guy to win, but man, you know, and when they signed Campbell, I was like, oh, at that price, you can have him. Well, the Leafs don't need him at that price. So that one, they did us a favor. So yeah, go Edmonton for doing it. They helped us out there.
I know our Oilers fans at our office will love to hear this part of the podcast.
You're churning in your skin. So okay. Last question about if they win, are you happy for McDavid? Not the Oilers or the fans.
Yes.
You're happy for McDavid? Okay, that's cool. I can respect that.
He's the best in the game. So
really
yes,
is.
you have to respect
he
that.
Really
you have
is,
to
man.
you have to want that for him, not necessarily the team, but for him. He's incredible.
Yeah. And he was close to being on the Leafs actually.
Yeah, that's right.
Yeah, they were right. They were right in the running there. They were in the lottery at that point too. He was very close to being on the Leafs, and I was like, I mean, hey, Matthews is good. I'm not knocking Matthews.
He's not McDavid.
He's no McDavid.
Well, no one
Nobody
is. You know what I mean?
And I can't see him in the playoffs.
Oh no! Hey, we're not going there. Edit. What's the timestamp? Cool. I think we'll leave it at that, guys. Anything else you guys want to cover?
No, just appreciate you having us, and look forward to chatting again.
Yeah, awesome. Absolutely. We'll do it again. We'll see what next time we can look at some case studies or whatever's going on in this. It'd be awesome. People would kind of get some insight into that and get an idea of that stuff. We can throw some stuff on the screen and we can share that up on YouTube and stuff. We can talk some
on the investing side too next time.
Yeah. Okay.
Yep.
Yeah. Awesome. Thanks, guys.
Thanks, guys.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.